Hello, and welcome to Mission Wealth's Market Perspectives for the second quarter of 2019. My name is Kieran Osborne. I'm the Chief Investment Officer at Mission Wealth, and I'm pleased to be presenting to you today our outlook on financial markets. This presentation will cover three broad themes. Firstly, we'll cover the strong rebound in stocks experienced year to date. I'll give you an update on the economy and the global economy, as well as the Fed and the implications for yields moving forward. Stocks have rebounded very strongly year to date, with the S&P experiencing its best start to the year since 1998. Unfortunately, many investors, in particular retail investors, missed out on this bounce back in stocks. In contrast, we at Mission Wealth participated fully in the equity upswing, maintaining a dedicated allocation to equities and, in many instances, added to our equity positions across client accounts where it made sense. So what helped stocks bounce back? Well, the Fed has taken a more dovish tone, communicating they're unlikely to raise rates this year, and we saw some positive signs regarding a trade agreement with China, both of which helped investor sentiment. Now, despite the bounce back in stocks, stock valuations are trading in line with historic valuation multiples. And we see that the most attractive levels are found within international and emerging markets, both of which may benefit more so from some form of trade agreement with China moving forward. Turning to the economy, we believe the current expansion will enter its 11th year this summer and become the longest ever. We cannot see a near-term catalyst that is likely to disrupt the current expansion, though we do anticipate growth rates to moderate from what we have seen earlier as the short-term benefits of tax reform wear off. Though we do expect there could be some additional stimulus from pent-up capital expenditure that's been waiting on the sidelines, waiting for some form of trade agreement to transpire with China. Despite recent cooling, the global economy and global trade appears to be picking up, and we are seeing some relatively strong numbers coming out of China in particular. Turning to the Fed appears to have adopted now a wait-and-see approach to monetary policy. They communicated they're unlikely to raise rates this year or any time in the near term, and they are scaling back their balance sheet normalization policies in September. One thing that gained headline attention was the yield curve inversion. Part of the yield curve inverted in March. However, we do not think that this forebodes an imminent recession. Moving forward, we think that we will be in a lower for longer interest rate environment, which means that the returns generated within core fixed income may be somewhat challenged. And so we are actively managing our core fixed income allocations accordingly, which I'll speak to. After a challenging 2018, you'll see in this chart here that all major asset classes are positive year to date. This is through the first quarter, through the end of March. We experienced the biggest quarterly decline in Q4 of 2018. That was the largest quarterly decline since 2011. The S&P 500 has now had its best start to the year since 1998. So after a sell-off, these markets tend to invariably rebound pretty strongly. We believe the fourth quarter sell-off in 2018 was really not driven by a material change in fundamentals. So what's helped investor sentiment this year has been two main things. One, the Fed has taken a much more dovish stance. They've communicated they're unlikely they're not going to raise rates again this year. And they're going to find it very difficult to raise rates moving forward. At the same time, we have seen some very positive signs regarding the trade war with China and some form of trade agreement. The market now believes it's not if a trade agreement will happen, but when a trade agreement will happen. And both of these factors really helped buoy investor sentiment year to date. Now, despite the strong rebound in stocks, many investors, and in particular retail investors, missed out on this large equity upswing, as evidenced by the chart on this page, which shows a very strong divergence in equity fund flows, the money flowing out of equities, despite the strong rebound in equity prices as depicted by the S&P 500. In fact, this is one of the largest divergences in equity performance relative to fund flows since the Great Financial Crisis. Importantly, and in contrast to this trend, by using our disciplined approach to portfolio rebalancing, we remained fully invested in equities and participated in this equity upswing. In fact, we were adding across client accounts where it made sense to equity positions at the end of 2018 and the beginning of 2019. Now, despite the strong rebound, US stocks have effectively come right back in line with their historic valuation multiples as measured by price to earnings multiples. So, in the fourth quarter, they really got undervalued or underpriced. They sold off too much and they've rebounded back to their long-term mean. So we view that stocks are not expensive, they're not cheap, they're right in line with their long-term averages currently. One challenge, however, for US stocks in particular will be cycling very tough earnings comparables from 2018 in 2019. So you'll see in this chart here the earnings growth rates in the first quarter, second quarter, and third quarter of 2018 were in around the 30% level. That's simply not sustainable. That was driven by the tax reform, which gave a short-term boost to earnings. But ultimately, we anticipate earnings growth rates in the mid-single digits for 2019. The one challenge will be cycling these very, very high growth rates that are, again, unsustainable to lower growth rates while still healthy in the mid-single digit range, but a lot lower. And so the challenge will be how investors in the market digest that. At the same time, international stocks are trading at larger discounts to US stocks relative to history. So while US stocks are right in line with their long-term averages, international emerging markets are trading still trading a little cheap despite the strong rebound that they've experienced year to date. And we think that if we do get some form of trade agreement with China, both international and emerging markets will particularly benefit due to the underlying global trade dynamics. On a global basis, the US market is relatively closed. It's not dependent upon global trade the same way that most international and emerging market economies are. Most international and emerging market economies are a key part of those economies are global trade in the form of exports and imports. It's an important part of the US economy. It's just not as large a component of the US economy as it is for international and emerging markets. And thus, we do believe some form of trade agreement will benefit international emerging markets more so than the US. We maintain a positive long-term outlook for stock market returns, but we do anticipate some moderation given the strength we've experienced in the first quarter. And we do see there are some ongoing risks abroad, especially with regards to Brexit. And there's been some renewed trade tensions that have hit headlines, particularly with Europe. Turning to the economy, we believe that by summer we will have entered the 11th year of the current expansion, and it will become the longest expansion ever. Now, we don't see any short-term catalysts. Despite the very long expansion that we've experienced, we don't see any catalyst near-term that could derail the ongoing expansion. Expansions don't simply die of old age. there is always a catalyst. And so we're actively looking for one. We just currently cannot see one near term. We do anticipate GDP growth rates to moderate somewhat from the strength that we experienced last year, and we do see those growth rates slowing towards the expansion average of a little over 2%. We anticipate around 2% growth rates for the balance of the expansion as the short-term benefits of tax reform do wear off this year. However, there is one positive that may be undervalued by the market, and that is we anticipate an additional economic stimulus from a trade agreement with China. There has been many capital projects that have been postponed or put on ice, awaiting clarity regarding trade policies, the rules of the road for trade, for global trade. Investors, the market, and businesses really dislike a lack of clarity, meaning any form of uncertainty prevents investment from taking place. And that we believe that's the case talking to our industry partners, that there has been a lot of businesses that have postponed projects related to global trade, awaiting clarity on the rules of the road. And if and when we do get some form of trade agreement with China, those projects and that capital expenditure may be unleashed, and it may provide an additional stimulus to the economy moving forward and an additional short-term boost to help further expand the ongoing expansion we're experiencing. One of the common causes of the death of an expansion is, at least historically, is Fed tightening. We don't think that that will be the case this time around. The Fed has already communicated that they are in wait-and-see mode. They've stopped their tightening policies. And despite recent increases in rates, interest rates right now are still historically low. And interest rates are not at that point where it's precluding investment. No investor is preventing them, or interest rates are not so high that they're preventing anybody from going out and investing, which had been the case in many historic time periods. At the same time, inflation is well contained and not an issue. It's not a cause of concern for the Fed to further raise rates. If you look at previous rate hiking cycles, inflation was a lot higher, and the Fed was trying to rein in inflation as part of their interest rate policies. So, and lastly, we don't see the level of excesses built up in the economy relative to what we've seen leading up to prior recessions. So ultimately, we don't think the Fed is going to be the cause of the death of this current expansion. And the Fed may actually be able to engineer a soft landing, given the fact that we really don't have the level of excesses built up in the economy that we have seen leading up to prior recessions. Turning to the global economy, global manufacturing indicators have moderated somewhat in the fourth quarter and into the beginning of this year. This chart, the short of this chart is green is good, red is bad, and you can see that, that generally speaking, while things were very green in 2018, that they've moderated somewhat globally from the manufacturing side of things. But we are seeing some positive signs of economic recovery, with more indicators improving than declining for the first time since midway through 2018. And global services are still strong. That's indicated in this chart here by the purple line, well above the 50 line. So 50 meaning anything above 50 is expansion, anything below 50 is contraction. And importantly, services make up a larger component of the global economy than manufacturing does. We believe manufacturing may be bottoming out and some form of trade resolution, trade agreement with China may help these numbers rebound relatively quickly. And global trade appears to be improving despite still waiting on some form of agreement with China. As you'll see in this chart here, trade volumes bottomed out in late January and have really rebounded quite strongly. And in particular, Chinese economic data is rebounding and increasingly favorable. Again, we anticipate a trade agreement to positively impact international and emerging markets in particular, and potentially unleash another round of economic stimulus in the form of capital expenditure that's been waiting on the sidelines, just waiting clarity around the rules of the road with respect to global trade, which may help push the global economy higher over the near term here. Turning to the Fed and their expectations, if you look at the key forecasts for the Fed, they really are in line with their long-term targets. Again, I spoke to this earlier, but inflation is not a concern. It's well contained and right in line with their long-term target rates, as is GDP growth rates. Unemployment is marginally below, but not drastically so. So really, in terms of economic data and where we are currently, there isn't a lot of impetus for the Fed to raise rates going forward. And the Fed really will find it difficult to adjust rates from their current levels. They've already communicated that they're not going to raise rates this year. They'll find it very difficult next year, given it is an election year, and they won't want to be seen as to affect the outcome of any election. So it's going to be very difficult for them to raise rates. At the same time, for them to cut rates, that would send a very a negative message to the market that they are concerned about economic growth. Turning back to the economy, we think that we may get an additional economic stimulus if we get some form of trade agreement with China. So the downside is less of a concern from that standpoint. But for Fed policy, we anticipate that we're in a wait-and-see mode for the ongoing or near term over the next year or so. The yield curve inversion has been a headline recently where the 10-year, 1-year spread actually hit negative territory for the first time since 2007. Despite the more widely followed 10-year, 2-year spread not going negative, although it did come within 10 basis points of hitting negative territory in March of this year. Now, importantly, an inverted yield curve does not forebode a recession. Inverted yield curves don't cause recessions, and they are imperfect indicators of recessions. There's only been 9 incidences going back to 1962, and 2 of those gave a fake signal. So, that is not exactly a pool of data from which you can draw a statistically significant conclusion from. Not only that, but it can take up to 3 years before the onset of a recession from the point at which the yield curve inverted. So it is an imperfect indicator. Historically, it has indicated a recession, but we don't anticipate that there is a recession going to occur near term, because we simply don't see a catalyst near term moving forward. And the last point on the current expansion as it pertains to yield curve inversion is that this current expansion and the Fed's reaction to the great financial crisis in 2008 was far from ordinary. There's nothing normal about this current expansion. So I would be extremely surprised if this current expansion died a normal death, so to speak. There simply isn't anything normal about this ongoing expansion that we're currently experiencing. So ultimately, the outlook for interest rates may be a lower for longer environment. Inflation simply isn't an issue, so central banks are not trying to rein it in by raising interest rates, as was the case during previous rate hiking cycles. The implication, therefore, is that within core fixed income, we're likely to experience relatively low real returns for the foreseeable future. And we're looking at a 10-year yield a little north of 2.5% and inflation around 2%. So backing that out, you're looking at around a 0.5% real return on that type of investment. So alternative yield opportunities may help generate enhanced income and total return potential within portfolios. We are actively managing our fixed income allocations with dedicated exposures to satellite fixed income, such as floating rate, which actually benefits from a rising interest rate environment, high yield emerging markets debt, as well as some other unique investment opportunities like direct credit, where it makes sense. All of these asset classes may offer enhanced return potential, enhanced yield potential in such a low rate environment going forward. So what are we doing with this backdrop? What are the actions that we're taking? We maintain well-diversified portfolios. Do not let emotions dictate investment decisions. We believe following a disciplined, long-term approach to portfolio construction and rebalancing will add value over time. We continue to favor a globally diversified allocation to equities. International emerging market equities are currently trading at attractive discounts relative to historic averages, whereas US stocks are trading right in line with the historic averages. International and emerging markets may also particularly benefit from a trade agreement with China. We are actively managing our fixed income allocations with dedicated exposures to satellite fixed income asset classes like floating rate, high yield, and emerging markets debt, along with other unique opportunities such as direct credit, which may offer upside potential in a relatively low interest rate environment. We believe our portfolios are well positioned for the forthcoming period, offering a globally diversified portfolio that may weather the potential for ongoing market volatility, a lower for longer interest rate environment, and the ever-changing geopolitical and economic landscape. Thank you for listening to this presentation today. If you have any questions, please don't hesitate to contact your client advisor.